Hey YouTube, Jason here with Day Trading Fearless. Welcome back to my channel. If you're new, welcome. Make sure you guys hit the like button and also subscribe to the channel. And as always, let's jump right into it. So today we're going to talk about the Theo option price kind of parameters in Thinkorswim. If you guys don't know how to use this or never saw this, it's a really good tool for trying to figure out what option pricing will be in the future, right? So I'm going to kind of give you a quick little tutorial of how this works. So the first thing we'll do is we'll come over here to single on the option chain. We'll use Viacom, okay, as kind of our main thing, whatever. And then from here, what we'll do is we'll click on Theo price and click reset. Make sure all this is reset. Now, what we're trying to figure out is for May 20, with 29 days left, these are all the calls over here. Let's say we want to buy the 42 calls, okay? And what are these calls going to be worth in a week from now? Okay, so what we'll do is we'll kind of say, okay, the bid ask, and we'll just go off the Theo price, right? The Theo price is the theoretical price, which is the mid price. So we'll say it's 230 on the 42 calls, okay? We're going to come over here and we're going to say, hey, right now, when I'm filming this was 4/22, okay, April 22nd. How much are these calls going to be worth on Friday, we'll say, okay, of the 30th, of April 30th? Okay, with everything being equal, the stock price goes up, it goes down, goes all around, and then we're right back here at 40.73 on Friday, April 30th. Well, what we come over here, okay, and we go, wow, what was 230 is only $1.91. Well, why is that? Okay, why if we bought these calls, why did it lose about 40 cents worth of value? Well, if we come over here and we change this and we look at our theta, okay, theta is, remember, if you don't know what theta is the rate of change that the option out of the money, the premium is going to decay every single day, right? And remember, as you get closer to expiration, that theta will start to go higher, more and more, right? So it right now currently has a minus 0.5 theta, meaning this option is going to lose about 5 cents every single day. Okay, well, if you think about it, if we come back over here, we go, okay, well, today's the 22nd. We know the 29th will be 7. Okay, that's 8 days. Well, 8 times 5 is 40. Okay, so that would be 40 cents. So remember, what was worth $2.30 is now only worth $1.90, which is 40 cents lower. So that's a good way to kind of go, oh, wow, okay, well, if I bought that and the stock doesn't move, I'm going to lose about 40 cents. But if I sold that, I would make 40 cents if the stock doesn't make a big move, right? Now, let's say we'll use the same numbers, right? April 30th, but let's now say the stock has moved down $1. We're going, or sorry, up $1. So we're going to add $1. We're going to adjust the stock price to plus $1. Okay. And now when we come over here, so by next Friday, what we paid $2.30 for is now worth $2.39. So the stock moved $1, but remember, we had 8 days of time decay that hurt us, but we also had a move in our direction with a delta of, we'll say 47. So net we're going to make about $9 on this trade. Now, let's say the stock actually had a $2 move within that same time period. Well, what we paid $2.30 for is now worth $2.94. Okay, that's not a bad move, right? Because with the $2 move, we actually have made about 64 cents on our $230 bet. Okay, or $2.34. Remember, options are a multiplier of 100, right? So we would have made probably about that. Now, let's say it's minus $1, okay, by next Friday. Well, what we paid $2.30 for is now worth $1.49, because now we have 8 days of time decay, but we also have the 47 minus delta, right? Because we're wrong. Remember, the delta is every $1 up or down in the stock price. That is what the option's going to do. So now, with that being said, let's say we have a volatility adjustment. Well, let's say the stock dropped $1, but as the stock dropped, let's say there was a implied volatility rise of, we'll say 1%. Okay, so now what we have is $1.53. $1.53. Watch this, right? As I go all the way back to 0, okay, it was $1.49, but because implied volatility rose 1%, we actually gained 4 cents of option premium. Because remember, as the implied volatility over here goes up in value, okay, then the option pricing gets more expensive, right? And vice versa. If it goes down in value, the option pricing will actually go, will start to become less expensive, right? It gets sucked out. Now, let's say all of a sudden, let's reset this, and let's say by next Friday, okay, the option moves $5 higher. Well, we know what we paid $2.30 for is now going to be worth about $4.95. Okay, so this is a really, really good tool to kind of understand and manipulate option pricing to what you want. And let's say that same $5 move doesn't happen until the first week in May, which is May 7th. Well, what was $4.95 is now $4.62, right? Because remember, we have the right to buy this at 42. Well, if with a $5 move, we'd be about 45, but we still do have some time decay left. So I hope this video really helps you guys to understand the option Theo pricing parameters that you can find. Remember, to be able to get this, you need to have option or Theo price showing on here. If you don't have it, then it will disappear. So as always, thank you for watching my video. Make sure you guys check out my website and Patreon page. The links are down below, and we will talk to you soon. Thank you.